Good afternoon, everyone. Thanks for joining us this afternoon. I'm sure we've got a few more attendees joining, but we thought we'd make a start promptly. Today's webinar is around CSOPs and the changes announced as part of Kwasi Kwarteng's mini budget, one of the few remaining items actually from that. So the question is, are CSOPs, company share option plans, reborn, being expanded, and how do they then measure up against other types of discretionary share plan that we can implement for our clients? The presentation will probably last about 30 minutes. There is a Q&A box as part of the webinar in front of you. Please put any questions in that, but we won't do Q&As at the end. We'll respond individually if that's okay with everybody via email. And if you've got any questions after the session, email myself and Seb directly and we'll respond to you. A recording of the webinar will be available on our website and also on our YouTube channel. By way of intro, I'm John Dormer, a director at RM2, and I'm joined today by Seb Salt, who is a senior consultant in our team. As far as the content is concerned, we'll cover what are CSOP options. Probably some of you be familiar with that already, but maybe quite a useful reminder. What are the changes that are going to apply to CSOPs and when will they take effect? And then once those are in effect, how will they actually measure up against other discretionary forms of share plan? The usual suspects really: EMIs, non-tax advantaged, unapproved options, growth shares and partly paid shares.
So let's begin with what are CSOP options. CSOP options are UK tax advantage discretionary share options, so they don't need to be offered to all employees. They were launched in 1996. It's important to note that we're talking about share options, i.e. rights to acquire shares in the future at a price which is set now, rather than shares. CSOP options need to have a market value exercise price. That market value can be agreed with HMRC, and it's often possible to agree minority discounts to reflect the lack of influence of the shares. The current limit is £30,000 per employee, which is measured at the date of grant. The shares themselves must be listed or in an independent company, meaning a company that's not controlled by another company. That can sometimes present a challenge for PE-backed companies. Where the company has more than one class of share, HMRC require that the shares must be worth having. That's interpreted to mean that they must be either employee control shares, a class of shares which in itself gives employees and directors control of the company, or open market shares, a class of shares the majority of which is held by persons that did not acquire them by virtue of their employment or directorship. This can be problematic in cases where a company has more than one class of shares and they either don't want to use an investor-specific class, or employees and directors don't control the company through their holdings of the intended share class. The use of CSOPs has declined. 4,270 companies used a CSOP in 2000, and that plateaued from 2012 to 2021 at circa 1,100 companies. CSOP delivers around 40 million worth of income tax and NIC relief in 2021, and we'll talk about how that compares to the EMI plan a bit later. From a tax perspective, provided a CSOP option is exercised either on or after the third anniversary of the date of grant, or before the third anniversary in specified good leaver circumstances or on certain types of company takeover, there should be no income tax or NIC at the date of grant, no income tax or NIC at the date of exercise, and capital gains tax only on the sale of the shares. The usual business assets disposal relief conditions apply. There's no special BADR treatment for CSOP shares. In terms of the CSOP changes to be introduced from April, the UK government recently announced that CSOP options would be expanded by increasing the individual limit from 30,000 to 60,000, with the 30,000 limit having applied since 1996, and removing the requirement shares to be in a class that's worth having. Those changes will take effect from the 6th of April 2023. This will serve as a boost to existing CSOPs, and companies would be well advised to check their CSOP rules to make sure that the increased limits can take effect effectively. It will create more flexibility around employee share classes where this has acted as a blocker for companies. The increase in the limit should allow companies to make more meaningful awards, £60,000, and it's now possible to combine CSOP options with growth shares, which we'll come on to talk about later. It also opens up CSOP for companies which had a share structure which previously made CSOP prohibitive, but the company will still need to be independent. The question then becomes, how will CSOP then measure up against EMI options, unapproved options, growth shares and partly paid shares? And the remainder of this webinar will consider that question.
So another plan that people will probably be even more familiar with, EMI or enterprise management incentives. A UK tax advantage discretionary share option plan, like a CSOP, been around since 2000. And latest statistics suggest that over 14,000 companies used EMI in 2021, which is about 13 times those using a CSOP, with an estimated 400 million in income tax relief and NIC relief, as opposed to the 40 million that Seb mentioned earlier. So like a CSOP, we're talking about share options, not shares, rights to acquire shares in the future, 250k's worth of shares per employee, £3 million worth across all employees, as per CSOP, measured at the date of grant of the options. The market value, like a CSOP, can be agreed with HMRC upfront, with minority discounts potentially being available. Importantly, the shares have to be in an independent company, similar to CSOP, but there's a wider definition there. And additionally, there can be no arrangements to control for any of the corporate. So actually, the scope of EMI is narrower than CSOPs as far as that independence requirement is concerned. There's limits on size for EMI, 250 full-time equivalent employees and 30 million gross assets. And importantly, limits on trading activities and subsidiary level interests. Both of those two elements can actually open the door now for CSOPs to be of use. The exercise price for an EMI can be set at any level, usually at least nominal value where you've got newly issued shares. And there's no minimum time period between the date of grant and exercise for the income tax and NIC reliefs to be available, although it's usually advisable to have a minimum period of 3 or 6 months between grant and exercise, so it looks and feels like a proper share option. Business asset disposal relief, another important benefit from EMIs, applies 24 months after the date of grant of the option, where you've got a sale of the shares on or after that date. The 10% rate can be on offer for that first £1 million worth of lifetime gains. And importantly, that clock, as we've mentioned, starts when the EMI option is granted. Worth saying actually that the government did carry out a fairly detailed review of EMI in 2021 through to early 2022, and identified that it had actually continued to meet its objectives. We're not expecting any extension or limitation of EMI on the back of that for the foreseeable future. So as far as the tax treatment is concerned, between CSOP and EMI, both no grant taxation when the option is granted. Exercise of the options can be tax-free for EMI, where it's a market value option at any time, but for CSOPs, as Seb mentioned, it's subject to a 3-year rule or early exercise, i.e. prior to 3 years, in fairly limited circumstances. CGT should apply on the sale of the shares, but for EMI, that business asset disposal relief clock starts ticking from the date of grant. For a CSOP, you're just subject to the vagaries and the requirements for BADR generally. So you need to have a 5% shareholding, votes and economic for at least a 2-year period from when you exercise the option to when you sell the shares. So the clock for business asset disposal relief starts later for any CSOP options. For both types of plan, corporation tax relief is available or potentially available when the options are exercised on the gain at that time. So in terms of where we stand or where we will stand on the 6th of April next year, have a comparison between the two plans. Independence requirements apply to both EMI and CSOP. but EMI is subject to a wider control test and also includes the arrangements to control tests, which can certainly in private equity backed businesses where there might be step-in rights can limit the availability of EMI. CSOPs, again, independent but not subject to those future tests, so potential there for CSOP to play a part where EMI may be blocked. Restrictions on trading activities, yes for EMI, certain excluded activities, lawyers, accountants, property developers, all outside the scope of EMI, but qualifying under a CSOP. Certain investment activities also, or investments, can cause issues from an EMI perspective where they don't from a CSOP perspective. Restrictions on size, as we've mentioned, 250 full-time equivalent employees and 30 million gross assets for EMI, no equivalent caps as far as CSOP is concerned. And working down the corporate structure, EMI has certain subsidiary level tests. 51% subsidiaries generally are required, 90% if it's a property managing subsidiary, no such tests for CSOP. So, as far as size, trading activity, corporate structure is concerned, potentially CSOPs have a wider ambit there. We mentioned the tax efficiency and the gateway to tax efficiency. EMI, no income tax or NIC thresholds in order to get any tax reliefs there, but 2-year qualifying period for BADR from grant to the option. For a CSOP, unfortunately, you've still got to wait 3 years normally for the options to be capable of being acquired on an income tax and national insurance free basis. Exercise price, EMI, it's sort of open season there, but usually options are granted at least the actual market value of the shares on the day the option's granted in order to secure the tax breaks. For a CSOP, you can't grant discounted options. They've got to be at least the unrestricted market value of those shares. 250k's worth versus 60k, obviously a key differentiator between the two plans in terms of individual limits. But as Seb alluded to earlier, with the flexibility now to use different classes of shares under a CSOP, potentially using growth shares, hurdle shares, that sort of thing, that 60k could go further than you might first think. You can use non-voting shares, growth shares, as I say, under both plans. You can have tailored performance conditions. Lever provisions commercially can be tailored as you see fit, but there are some tax issues around CSOP options and the definitions of good levers and how exercise provisions apply around that, which mean actually in order to secure certain tax breaks on a CSOP, you've got to get the drafting right, so slightly less flexibility there. Both plans give you the taxation and valuation certainty of being able to go to HMRC and agree the values. As I mentioned earlier, there's a slight difference in terms of where you set your exercise price based on the AMV for an EMI option and the higher unrestricted market value usually for a CSOP option. No automatic business asset disposal relief qualification under a CSOP, unfortunately. There is for an EMI where you go through that 2-year period. So EMIs, again, part of the magic there is small, uninfluential minority shareholding below that 5% threshold can still qualify for a lower rate of CGT on sale. So in terms of where we are, I think that the gap has been closed. There's far more equivalence in terms of the flexibility across both plans, which is great news. EMI remains the holy grail, I suppose, for companies and employees that qualify through its combination of tax efficiency and commercial flexibility. EMI still has the edge from a tax perspective, from a valuation perspective, so 250k versus 60. The ability to exercise options before the 3rd anniversary of the date of grant and still benefit from income tax and national insurance free exercise. CSOP options, pre-3-year takeovers have to be in a cash form, usually in order to benefit from any income tax and national insurance breaks. More flexibility in terms of where you can set your option price for an EMI. And as we've mentioned on a couple of occasions already, EMI is benefiting from those special BADR, business asset disposal relief benefits. I think CSOP, though, does have a position now as a more useful super sub, to keep the World Cup analogy going. Those companies that are too big for EMI through their employee numbers or their gross assets, if the trading activities requirements for EMI are not met, property developers, accountants, lawyers, and where the subsidiary tests or investment activities might mean that EMI is not available. But I think that gap in terms of the tax breaks and the tax efficiency, it really mirrors the government's aim for EMIs, which is to try and bridge the skill gap to enable smaller growth companies to compete with larger corporates, hence the enhancements in those benefits when compared to a CSOP.
So moving on to unapproved options, again, a discretionary share option plan, but in this case, the options aren't subject to the company, or there are no restrictions in relation to the company, the shares, the employees, or any limits on participation. In practice, they're sometimes used by companies in addition to CSOP, above the participation limits, or as a direct alternative where the company or the employee doesn't qualify. They don't confer any particular tax advantages on the company or the employee. So from a tax perspective, on the grant of an unapproved option, there is no income tax or NIC, and the same can be said for a CSOP option. The difference really lies in the exercise of the option. So on the exercise of an unapproved option, there will be income tax and, if applicable, where the shares are readily convertible assets, NIC on the gain at that point in time. Compare that to a CSOP option, there will be no income tax and NIC where it's exercised in a tax qualifying manner. So subject to the 3-year holding period and the possible early exercise exemptions. On a sale of the shares in both cases, there should be CGT, and in both cases, it should be possible to secure CT relief, provided conditions are met. So to look at CSOP options versus unapproved options, in conclusion, due to their tax advantages, CSOP options are likely to be the preferred choice, particularly where the company and the employee qualify, and it's possible to accommodate the company's commercial objectives within a CSOP option. Even if the company does qualify for CSOP, unapproved options may still be seen as appropriate. This could be where there's a desire for commercial flexibility, and that's seen to outweigh the tax advantages of the CSOP. For example, where the company wants to grant options with a discounted exercise price, such as nil or nominal cost options. They could also be seen as preferable where budgets and timescales are tight, because there's no need to get the valuation approved by HMRC, implementation is generally speedier, and the documentation is simpler.
So moving on from option-based plans, an alternative method of incentivising key employees within the business, the acquisition of shares via a share acquisition plan, and that can take several different forms, has different labels, there's no magic to the names. But the common feature of all of those arrangements is that shares are acquired upfront directly rather than via a share option. Usually a new issue of shares, and potentially a transfer of existing shares, but typically a new issue of shares in the company. As you're actually awarding shares upfront to employees, in the same way in which it's important where you've got options that aren't exit driven, that you get the commercial design of the share rights absolutely right. So what voting rights should they have, what dividend rights should they have, what capital rights, transfer rights, and compulsory transfer provisions should apply. Absolutely essential with any direct share award to make sure that those potential minority shareholding mischiefs are properly managed from day one. Where you've got a share acquisition arrangement, generally employees pay or agree to pay the full market value for those shares at acquisition, or alternatively, they suffer an income tax liability on that discount, which can be subject to PAYE, national insurance, or it could be a self-assessment issue depending upon the circumstances of the company. But if structured correctly, having taken that bit of pain on the way in, either by paying value or paying tax on that value, the aim is that the growth in value of those shares should be subject to the lower rates of capital gains tax rather than income tax and national insurance on any subsequent growth in value. But really, to work effectively and make sure that that pain is manageable, the upfront investment cost or the tax costs really need to be at a non-prohibitive level. And if there's significant value in the shares, then the next step is usually to consider using growth shares or partly paid shares to manage that risk. So growth shares, just as a headline, really this is about making the shares more affordable. Discretionary arrangements, potentially very tax efficient, not HMRC approved unless you use one of the EMI or CSOP wrappers, involve a direct share acquisition, again with the aim that the growth in value is subject to lower rates of capital gains tax. A new class of share is required, obviously with that careful structuring around the employee's rights to vote, transfer, dividends, etc. Importantly, the growth shares are subject to an entrenched capital value hurdle, which is typically set at a premium to the current value of the company. One benefit of that is protecting current value, potentially part of future value for existing shareholders. So growth shares are often attractive from a commercial perspective for existing shareholders in reducing any dilutive impact to them when those shares are issued. They can be particularly beneficial actually if you've got a new management team coming in who are there really to drive future growth in value, as opposed to sharing an existing value that maybe the founders and the existing management team have helped to generate. Typically, they'll require some upfront investment from the employee, or at least paying tax on the initial market value of those shares. But the aim with a growth share and working alongside a specialist valuer is to manage that upfront unrestricted market value due to the existence of the hurdle. Valuation is absolutely key, and of course, unless you're using a CSOP or EMI, you can't get that blessed by HMRC in advance. But as Seb has mentioned, it's possible to use a growth share within a CSOP from the 6th of April 2023, potentially maximising how much further that increased 60k limit go. So partly paid shares, another form of share acquisition arrangement. This is not about reducing the cost in the way in which a growth share does it. It's about deferring when payment is actually required for those shares. Can be used in conjunction with a growth share to get the benefits of a reduction in cost and a deferral, but usually structured in a way that the value, the initial value for the shares, is only payable when there's upside, typically on the happening of a future event. So a discretionary, potentially tax efficient arrangement, not HMRC approved, direct awards of shares. The employee agrees to pay the full initial unrestricted market value of the shares, but only pays a small amount, usually the nominal value, at the point the shares are acquired. The employee then agrees to pay the remainder of that initial market value when called for by the company, which typically on the happening of an exit event, when there can be greater value to fund that acquisition cost. Importantly, and unlike a share option, the unpaid amount must be paid even if the share value falls or the company goes into liquidation. Waivers of that amount can take effect, but would give rise to tax implications at that point in time. So their risk profile is significantly higher than an option where an employee can decide whether or not to exercise. Here they're committing, contractually agreeing and undertaking to pay that future value on the happening of future events. As in the case of all share acquisition arrangements, you need to structure the employee share class rights very carefully. Could use growth shares and combine that with a partly paid share arrangement to get the benefit of both the value reducer element of a growth share and the deferral benefits that are offered by a partly paid share. Employees can end up paying a small income tax liability on the amount that's outstanding, depending upon their particular circumstances and their role within the business. And valuation, as always, is key. That can't be agreed with HMRC, like a growth share outside of a CSOP and EMI.
So to conclude on CSOP options versus growth shares and partly paid shares, they're fundamentally different structures. One is a share option, one is an upfront acquisition of shares. As we've mentioned, CSOP options and growth shares are no longer mutually exclusive, and it's possible to combine the two. This can help to reduce the unrestricted market value of shares and hence the exercise price of the CSOP options, and will also allow more shares to be squeezed within the £60,000 limit. Growth shares issued outside CSOP or partly paid shares may still be preferred where upfront shareholder status is seen as important and an element of investment risk is seen as beneficial, a certain amount of skin in the game. CSOP options alone may be preferred to growth shares and partly paid shares due to the greater complexity and implementation costs associated with growth and partly paid shares, the greater risk associated with partly paid shares, that John has already talked about, the fact that the employee will be on the hook for the full restricted market value, and a liquidator could be able to call for that amount if the company was to. There's also the inability to agree the valuation outside the CSOP or EMI wrapper, and more complex valuation advice will be required for a growth share, applying the forward-looking valuation methodology. So, in conclusion, the CSOP relaxations are undoubtedly helpful. It should serve as a boost to existing CSOPs and allow more companies to qualify. There'll also be greater flexibility in design due to the share class relaxations. EMI still reigns supreme, even though, as John mentioned, CSOP is now a good super sub.
Thanks everyone for your time. We'll endeavour to answer any questions that have been raised in the questions box, but as I mentioned earlier, do email either of us or both of us if you have any questions that arise after today's session. Thanks again for attending, and I hope you found it informative.